Material we're diving into today is an exceptionally detailed stock analysis arguing for a strong buy on Alphabet. And it's all driven by that record $100 billion quarter. And of course, accelerating AI growth.
It is a tremendously strong opening premise. I mean, the material makes a really compelling high-conviction case. It highlights the cloud growth, that massive backlog.
The 34% cloud growth, yeah.
But look, when you're targeting a sophisticated critical audience, the goal isn't just to be right. It's to be bulletproof. So we need to focus on how to make this analysis, fully robust for the most skeptical reader.
I agree. Robustness is key, especially with the stock's recent volatility. So where's the most significant structural weakness we should tackle first?
We need to turn the spotlight onto the critics. To elevate this high-conviction analysis, the material needs to preemptively integrate and dismantle most common counter-arguments against Alphabet's current valuation.
I see that omission. The analysis does an excellent job justifying the premium PE ratio. It's around 32x right now, pointing to that growth reacceleration.
And the huge revenue number.
And the huge $102 billion revenue figure. But if you're asking the market to tolerate that premium multiple, you have to define the risks. It notes critics worry about AI search cannibalization, but it doesn't really resolve that concern financially.
Right. And it's not enough to just mention the risk. You have to defeat it with data. The historical volatility of Alphabet's PE is, it's well documented. So if you're going to stake your strong buy rating on the stock maintaining this premium, you need to build an intellectual fortress around it. Leaving the bear case implied just makes the whole thing vulnerable.
I'm with you on hitting the bear case head on. But how do you do that without sounding defensive? We don't want to get bogged down in the negatives.
You turn that defense into a structural strength. So the suggestion for improvement is to dedicate a short, high-impact section to just stress test the assumptions, particularly around ad revenue stability and AI talent spending.
So you transform weaknesses into acknowledged, managed risks?
Exactly. You're showing mastery over the downside.
Okay, let's talk specifics. Defending that premium valuation. How can the writer financially justify a 32x PE? I mean, that's demanding, even for this growth.
Okay. That backlog is years of high-margin revenue visibility that just wasn't there when Alphabet's PE was lower.
That's a powerful way to frame it. So you're repositioning the backlog not just as a growth metric, but as a stability metric to defend the multiple. But wait, is it really legitimate to treat future money, even committed money, as a defense for the present valuation?
It is, if you anchor it properly. The difference is the contract structure. It's not a prediction of future sales. It's a non-cancelable contract. It defends the multiple because it puts a floor on future revenue growth, and that drastically reduces the earnings volatility risk.
It's like an insurance policy.
An insurance policy the company has written itself. Exactly.
That clarification is necessary to include. Okay, let's go back to the biggest fear the bears have. AI cannibalizing core search.
Right. So the analysis outlines the drag on revenue from advertising maturity, but it has to immediately follow up with a defensive statement showing how the 34% cloud growth, that $15.2 billion, structurally mitigates that specific risk.
So the argument becomes that cloud growth isn't just some other exciting story. It's the financial antidote to search saturation fears. It's the proof of diversification.
Precisely. Quantifying that is key. And one final thought here. Since the writer uses technicals, they should use them to strengthen this point. Maybe explore a counterargument. If the $330 support level fails, what fundamental event could cause that?
That's a great point. Analyzing the failure scenario adds a ton of robustness. Okay, moving on to our second opportunity. This one seems to be about connecting the dots between AI strategy and the actual financials.
Yeah. The connection between the full-stack AI strategy, specifically consumer-facing stuff like Gemini 3, and that record $100 billion quarter needs a more direct and quantified linkage.
I can see how that feels underdeveloped right now. The material strongly says AI is driving the strong buy narrative, which is great. It cites cloud growth. But it kind of treats the revenue milestone and the Gemini launch almost as separate points.
They're presented near each other, but they're not narratively integrated. The core argument is that AI is accelerating overall growth, not just cloud. And we have to remember cloud is only about $15 billion of that total revenue.
Right.
The other $87 billion, mostly search and YouTube, that's where the real skepticism about AI's impact lies.
It's the psychological barrier. If AI is the reason for the strong buy, it has to be the reason for the entire revenue surge, or at least be shown to be defending the core. The weakness is that the AI argument is just too narrow right now.
Precisely. So the suggestion for improvement is to focus the narrative lens on showing how Gemini 3 and general AI adoption are impacting those other segments, the ones that contribute that remaining $87 billion. That's what makes the AI growth argument truly holistic.
That's demanding, though. It requires more than just saying Gemini is popular. It requires what? A structural hypothesis for how consumer AI translates into financial defense for search?
That's the heavy lifting you have to do. They need to introduce a hypothesis for how rising user penetration of Google's AI tools directly defends or enhances core search revenue. Is it leading to higher search frequency, more complex queries that allow for higher value ad slots? They need to speculate on that mechanism.
Okay, that bridges the gap. Now let's go back to that enormous $155 billion cloud backlog. It's a fantastic number, but it's still future revenue.
It is impressive, but it's future money that needs an activation timeline. The materials should provide a projection, even a directional one, on when that backlog size will start really hitting the quarterly revenue figures.
That would turn it from an impressive metric into an immediate driver of those 2026 high targets the writer sets, the 355 to 380 range.
Exactly. It solidifies the connection. And one last point on this. The material notes net income crush expectations by 35%. That's a huge beat.
And it raises a critical question. Is that margin improvement from AI optimization, running infrastructure more efficiently, or is it purely volume?
Clarifying that adds tremendous weight to the AI is accelerating growth thesis. If AI is lowering the cost of delivering services, that's a whole new bullish layer to the argument.
Right. It ties the AI story back to the bottom line. Crucial. Now for our third and final critique. This one is about integrating the technical analysis.
Yeah. The technical analysis, while it's accurate, can be transformed from just a basic observation into a powerful piece of evidence that actually reinforces the fundamental thesis.
Observations like the dip and rip pattern and that key $330 level, they're correct, but they sort of stand alone, separate from the catalyst discussion. For this kind of audience, just saying institutional support is buying the dips is, well, it's expected.
It's a truism. The opportunity is to explain what institutional money is buying into. When the price action confirms the fundamentals, you get a much stronger narrative. Right now, the technicals are like a separate chapter, not a visual confirmation of the story.
So we need to stop treating the chart as a predictive tool and start using it as a retrospective confirmation tool.
Exactly. The suggestion here is to anchor the price action commentary directly to the fundamental catalysts mentioned in the report. Use the technicals to tell a deeper story about how smart money is reacting to specific news.
Okay, so let's use a specific example they cited, the BNP Paribas Exane upgrade on November 24th.
Perfect. Instead of just noting the stock closed near the high of the day, connect that dip and rip directly to that upgrade. The language should suggest that institutional traders were accumulating shares precisely on the news of AI monetization.
So the technical pattern isn't just random noise, it's a high-conviction reaction to a specific fundamental catalyst. That's a really sophisticated level of integration.
And furthermore, they should frame the technical break above that psychological $330 level not just as clearing a hurdle, but as confirming investor conviction in those high-end analyst targets of 355 to 380.
It turns a simple technical level into a fundamental breakthrough.
Right. And finally, they can use relative strength or volume anomalies around that Q3 results release, the record revenue number, to visually underscore the re-acceleration they mention. It makes the chart speak directly to the financials, closing the loop. It really justifies the title, Google Stock Analysis, Strong Buy Ratings, and Record Financials.
This has been a very insightful look at an already powerful piece of work. The analysis starts strong, but I think these refinements really will push it over the top, make it bulletproof.
Agreed. So to quickly summarize for the listener, focus on three major opportunities. First, proactively address and mitigate the bear case to justify that 32x PE, using the cloud backlog as a structural defense.
Second, draw a clearer, quantified financial line between consumer AI adoption, like Gemini, and the overall non-cloud revenue, making that AI thesis truly holistic.
And third, integrate the technical observations, like the dip and rip, directly with fundamental catalysts, like that BNP Paribas upgrade, to create a much deeper narrative about smart money conviction.
The material already makes a strong case. Applying these refinements will make the analysis fully robust and pretty much impervious to skepticism, which is exactly what an institutional audience demands from a strong buy rating.
We're eager to see the strengthened version of this analysis. We invite you to implement these suggestions and submit your improved work back to us for a follow-up. Until then, keep digging into the data and challenging your assumptions.